Hello traders, Gary Wagner here, approximately 11:15 in Honolulu, Hawaii. It is Tuesday, the 23rd day of August, and this is the Daily Report for Gold. We do have gold currently experiencing a fairly moderate to moderately severe round of profit taking, trading off about $70 on the day, $68 currently, trading at 1830.28 as you can see on the board. And when we look at our weekly chart and our daily chart, you can see really how deep of a correction this is. My personal sentiment right now is this correction was overdue. It was to be expected. And as we look at this chart, you have a sense for the high, and this of course is a record high, to our current print, as I said, at around 1830. On today's report, we'll talk about the trade that we just exited. We will also speak about my interim and longer term views of the market, all here on today's Daily Report. The first thing that I kind of wanted to go over, and I want to do this very, very briefly, is the current trade that we just got in and got out. On the 21st, I did make a recommendation to enter the market from the long side. Traders, we took that call roughly at 1873. Now, the market, in fact, did go much higher. But when it hit this top, and this is what I'm going to talk about today, it hit a certain area that we had, and it was one of our targets. It was one of our soft targets. Our hard target was somewhere around 1903. But once it hit that point and backed off, my sentiment was, let's go ahead and raise the stop. We raised our stop to 1880, and we got out with a very, very small profit, about $7. But considering the fact that we were long at 1763, we were long at 1790, and then we pulled out of all of those positions at 1840, which was right here, and that was following a really brilliant trade in which we, in essence, got in at 1867 and out at 1785. We have had such good trades under our belt that I certainly didn't want to taint that with a trade that wouldn't produce a profit for us. So fortunately, we were able to absolutely exit that market, and exit that market in a way that it was very, very profitable for us. Now, what I want to do right now is give you an idea or an indication of what study I was looking at that really gave me a sense that we might in fact be close to a top. And this is it here. You know, I have been using the Fibonacci extensions. And when you think about it, traders, when you're at these record tops, the only thing that you can use really is a system such as a Fibonacci extension or a Elliott wave forecasting technique, which looks to take a fifth wave and calculate the approximate price move you'll see based on wave one. But you need to use something like that. So when I looked at that, we had a couple of what I'll call soft and then hard targets. And as you can see, as this market came up, we're looking at a 360-minute chart. But as this market came up, you can see you get the series of dojis right in here. You really get this cap here, which is that three-river evening star. I look for that in the morning star. But the key was, it was coming out, as I said, one of my soft targets. And what I mean by a soft target is these are the Fibonacci extension short term that I was looking at. 1960, 1941, 1925, 1909, and 1889. Now, when it hit this particular soft target and it backed off the way that it did, that to me was the indication that we're probably going to enter some sort of a corrective phase. And because of that, we went ahead and issued our signal to raise the stop, and once again, that stop got us out with a very small profit. More importantly, that stop got us out without incurring a loss, and that's what's critical. So the big question has to be, now that we are in a correction, where can we expect, where can we see this market go to? And to do that, really what I want to do is take a look at a basic Fibonacci extension. The extension that I'm going to be looking at right now is, excuse me traders, that extension that I'm going to be looking at right now is going to be based upon the entire move from 1480 up to 1916, and thereby give us some real strong indications of what the possibilities are. Now, in a typical correction, you will see the marketplace correct either to on a shallow correction, 23%, and a deeper correction will go to 38%. So our targets are on the what I'll call a hard target, where I think you have some likelihood, because this is a deep retracement line. It's not a shallow line. It's not going from the last part of the wave, but this entire rally. 1813 could easily be a place in which we witness some strong support coming into the market. If in fact that does not hold and the market continues to correct, and that of course is assuming that this correction isn't over, but as I said, this market has gone up parabolically so quickly so far that the next target then would be based upon this particular Fibonacci retracement, and that would take the market to about 1750. Now, there are other targets that will work in between these that will be based on much shorter Fibonacci retracements. But for right now, I think what is important is that if the market continues to drift lower, we should have very good support right at the 1803 to 1813 area. And that's the area that we're really going to want to focus on, and the area that easily could find some support. Now, traders, there's one other way that we need to be looking at this market to see if we might in fact have seen just a short, call it a blip, so to speak, and that is when we do a shorter retracement. Now realize this retracement, unlike the last one, which was done off a weekly chart, this is off of a daily chart, and I'm using the bottom at 1725, our top right around 1911, and I am only looking at this, call it this last rally since we had that small correction from these 2 points. What I find interesting when I actually do that calculation is that what we have witnessed in this one day, this trade down about what, $68, $70, is the marketplace actually gave back about 50% of the gain. Once again, here's at 1818. We saw an 1813, which was the 38% of the deeper retracement. 50% takes us roughly to the same place. Therefore, we've got a harmonic band between 1813 and 1818, and traders, that might provide us with an opportunity to re-enter the market from the long side. Do I think it's time yet? I think that the best bet at this point is a little bit of patience. In other words, what I recommend is we want to see if we get follow-through selling. The fact that we're going to get a little blip up right now, that can be due simply to traders that initiated shorts pulling profits. So that doesn't tell me that this correction is over. But in terms of the numbers, we are going to what I consider to be important numbers, and numbers that we do want to look at for a possible bottom activity. Lastly, and let me end the show with this one thought. Do you and do I believe that we have had, let's call it a pivotal key reversal? In other words, has anything fundamentally happened within the news that is going to change either your or my long-term underlying bias for the metals markets, the precious metals markets, specifically gold? You can answer your question your way. My answer is no. Really, nothing has changed. This is a well-needed and healthy round of profit-taking. Traders, luckily enough, we pulled out with profits before they really took the market down. This has been Gary Wagner, wishing you, as always, good trading. We'll talk to you tomorrow for another daily update and review. Bye-bye.
Many sights to see, and when I look in my window, so many different people to be, that it's strange